Hello everyone and welcome back. In this video we are going to talk about FICO. At what price will I buy FICO again? I was a shareholder in the past, I sold and I want to get back in. And if you look at the stock price of FICO, actually it is trending down. As I'm shooting this video, the stock just reported earnings and the stock continues to go down. We just crossed $1,500 again. The stock continues to go down and the stock is having right now a 38% decline. So 40% drawdown is significant. In this video, I will tell you the price at which I will buy FICO, the things I am monitoring, and we will talk about the report. How good was it? Was it important or not? What are the things to monitor if you want to buy FICO in 2026? Because I think we are in front of one of the best business models on earth, but you have major risks to consider. So the business is not perfect. This is in a niche market, monopoly, but in one law, everything can be destroyed. So really, there are some things to monitor for FICO, but I think if you have the opportunity to buy FICO at a good price, you can make 20% per year. So yeah, pretty good risk-reward opportunity from this point of view. In case this is your first video from this channel, welcome. My name is Christophe Noor. I'm French. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And thanks to FICO, because I rode the wave of this stock when it was going up. So if you don't know FICO, basically this is the company behind the FICO scores in the US. And over the past few years, since 2017, something changed for their business model, and they had the opportunity to raise prices for their FICO scores. So in the past, a FICO score was what? 50 cents. They increased these prices to $1 every time somebody asks for a FICO score. And then $2, $3, $4, $5. Guess what? People need these FICO scores. Companies need this FICO score. This ecosystem is so entrenched in the US economy that people don't care. It will cost $1 or $5, $10 or $8 or $10. People don't care. So actually, Fair Isaac has the potential to continue increasing their prices and to grow this pricing power very far. So this is their biggest component of their earnings, but they also have another segment called the software. I can show you what I mean because I can show you on Fiscal AI the segments and KPIs, and I can click on comment size to show you how important that is. So for scores, should be it. Scores revenue represents 60% of the revenue. Okay. In the past, it was not the case. In the past few years, the score segment, like 10 years ago, was 25% of the revenue, meaning the remaining 75% of the business was software. But the score segment has grown so well that it is now 60% of the company. And you can check what are the margins of both segments, what are the EBIT of each segment. Here is what you have for the software part and the score segment. The score segment, as we said before, represents 60% of the revenue, but it represents 111% of the operating income, which means we are in front of a business that is really, really, really profitable, and the most profitable segment is growing in importance. So in the future, you can expect the overall margin profile of this business to improve massively. This is already happening. As you can see here in 2018, 2019, margins went up, operating margins went up from 18% to 20% to 30% to 40% to now 50%. So a business that is extremely profitable, and my opinion is it will stay profitable. I want to highlight the first risk. Something changed when it comes to regulation in 2018 and untapped this pricing power potential. What if, for some reason, the regulation changes again and prices for the FICO scores are capped. What if you no longer have the possibility to grow the FICO scores by 20% per year? Sometimes in some mortgage markets, they double the prices in 1 year. What if the regulation changes and you are capped to a 5% increase every year? It is possible. You have a low probability of it happening. People had this worry for years and years and years, and nothing has changed. But something definitely changed in 2018. You can reverse back to the old regulation rule. Something to monitor, maybe one of the most important things to monitor. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Now, if you look at the revenue trends of the report, the company delivered a very good earnings report very recently. A few days ago, January 28th, the company reported earnings. This is their equivalent of Q1 2026, and they delivered pretty good results. If you look at the revenue, you are up double digits. Revenue is up 16%, and the earnings went up. The margins went up. You have some adjustments to make, but basically the company is in a very good shape. Some people will look at the earnings per share and they will not be enthusiastic and happy. Look at this. Even the net income. Net income on a quarterly basis is not great. The net income of the company has grown 4% year on year, but this is because of a tax change. Actually, I can show you what I mean, because in the past, 1 year ago, the tax rate, look at this, December 2024, the tax rate was minus 1%. Yeah, like you had a tax benefit back in the days. And now the tax rate is 17%. So you have to really compare apples to apples. Now the net income 1 year ago and the net income now is different, and the growth rate is horrible because the tax rate is different. So you really have to adjust for this tax rate. And if you adjust for this tax rate, everything is moving in the right direction. The revenue is up, the margins are still fine, the net income is up double digits, they are doing buyback, so everything is up double digits. Actually, now the company is very profitable. They are doing a lot of cash flows, and they are doing a lot of buybacks. I can click on cash from operating activities, click on the capex lines, and click on buybacks. By the way, you see me using a fiscal AI. You can use my discount code in the description to get it cheaper. It will get cheaper for you if you use my link. It's a beautiful website that you can use for your own investing journey. It's a wonderful website. I think you will not be disappointed. Okay, in the blue line here, you see the cash from operating activities. You see that this is a business that is growing their efficiency over time, and the cash flows are growing over time. In purple and in orange, you see the capex of the business. Here you see a small orange line. It's very minimal for the capex. In purple, you have the software capex, I can call it this way. In purple, very minimal. So the company doesn't need capex to grow, which means all the cash the company generates is used to do buybacks. The company stopped a small dividend payment in 2017. The company is doing massive buybacks. And actually, you see the orange chart is bigger than the blue chart. The company is having more outflows with buybacks than they generate cash. They are very bullish when it comes to their own stock price. And this trend has been here for many, many, many years. Look at the past 10 years. The orange line, the orange part was always similar or superior to the blue chart, which means all the cash flows of the business have always been used to do buybacks. And I can show you an even better metric. I have created a custom metric for this business to show you the percentage of cash flows and buybacks, percentage of buybacks compared to cash flow. You see that this chart was always very high. And now the company is using 200% of their operating cash flows to finance buybacks. What does it tell you? It tells you that the company is taking more debt to fund these buybacks. I can go back to Guru Focus. We've seen the margin profiles. We've seen how profitable they are and growing double digits. Look at the debt level. The debt level is quite high. The company is taking more debt more aggressively to fund these buybacks. This is how confident the management team is. The management team is extremely bullish for their own business. So they really think they can grow 20% per year for the next 5 years, 10 years. So they are taking debt to invest in themselves, even though the stock price is quite high right now. If you look at all the metrics, everything will point out to good news. And now I want to talk about valuation. Valuation, fair enough. This is very important. You can look at the PE ratio. You can look at the price to free cash flow. This will be pretty similar as we've seen before. I mean, this is a very cash generative business and asset light business model. Right now, the PE ratio of the business is 54 and the price to free cash flow of the business is 46. Based on my research, I would say price to free cash flow is a better indicator of valuation for this business. But a lot of growth is priced in. So maybe you can look at the forward price to free cash flow for this business. The forward price to free cash flow for this business is 30. In the past, this valuation in orange was very high, was 76. The business went down a lot. The stock price is down 30%, 38% from highs, but the valuation got cut in half, more than this actually. So now FICO has become maybe fairly valued. Now, we just entered fair valuation for Fair Isaac. A few months ago, the stock price went down, and the stock price went down to $1,300. But even at this time, the forward price to free cash flow was 36. Now, the stock price has rebounded and down a little bit, but the guidance is so high, the expected cash flow is so high, that the valuation is shrinking. Why? Because the business is reaccelerating. And if you look at what is priced in from Wall Street is extremely bullish actually. Wall Street is quite bullish for this company. Wall Street thinks that the free cash flow of the business will grow at 30% in 2026, 30% in 2027, and 17% in 2028. It's possible. And many analysts on Wall Street wanted to know what will be the growth rates in the future. And I listened to the earnings call. The management team literally said, we are in a good position, we are very profitable, and we see no major hurdles. The business model is changing a little bit. We'll go directly to the consumer. We are already doing deals, partnerships. Everything is moving smoothly. So don't worry, guys. The business will maybe change a little bit in 2026, but not now. So maybe in the next quarter, we will give you more updates. In the meantime, guys, everybody, the business is in a good shape. Okay, this is the TLDR of the earnings call. And then you had some Wall Street analysts saying, last quarter, so now we are in Q1 2026. Last quarter, so Q4 2025, you said that you were very conservative in your guidance. So now you are saying that everything is going smoothly. Do you have any updates on this guidance? Last quarter, you said you are very conservative. Look at this. I can show you right away so you don't have to do the work at home. Q4 2025, the management team said we are pretty conservative in the way we are doing the guidance. We are probably more conservative this year because there is a lot of uncertainties in the macro environment and the timing of this. But frankly, we are being very conservative. Very conservative, very conservative, conservative. Again, we are all being very conservative. I mean, we are looking at this. I think we are always conservative, but this year we are probably more than other years. We are very extra conservative. And then again, we are being conservative, and again, we are being conservative. 8 times the word conservative was said. Now we are next quarter, Q1 2026, and the guidance has not changed. So Wall Street analysts said, okay guys, you said you were conservative. Can we have a little bit of an update here? I mean, how conservative are you? Will you really increase your guidance now? And the management team said, no change from the management team. You guys are too focused on the short term. You guys are Wall Street analysts. You just want to fill your Excel spreadsheet, which is very right. I know this from experience. So no, we will not change the guidance every quarter. Most likely next quarter we will give you the guidance, but we are not in the team of changing the quarter. I mean, it's much easier for us to not raise the guidance, and in the next 3 months, in the next quarter, we will have more visibility for the year, so we can increase the guidance. We'd rather do this rather than increasing the guidance and then having the visibility and things are not as good as expected, so we have to lower the guidance again. So let's just play it cool. Expect whatever you want to expect, but we are not touching the guidance. Wall Street analyst said, okay, thank you very much. This is a lovely answer. Thank you very much. Next question, next analyst. Hey guys, I see you are being conservative. Can you explain a little bit your guidance? The management team answered the exact same thing. Third question, third analyst. Hey guys, nice guidance. Can you update the guidance a little bit? Basically, Wall Street doing Wall Street things. So I think the management team of FICO is being very conservative. I have checked all the past guidance for the past 10 years. Every time they issued guidance, they raised guidance. Every time they issued guidance, they did better than the normal guidance. I checked the results since 2017, I think, 2018. For the software part, not good. For the score segment, extremely good. They are always beating their estimates. They are always beating their guidance. So when they tell you the business will grow at X percentage, you can expect almost for guarantee that they will do more than this. This is my opinion. Maybe I will be wrong. Don't follow me on this trade. This is what I think. And now, if you look at the guidance, what do we have? What's the latest information we have on the guidance? The guidance, no. FICO is reiterating the guidance, blah, 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 blah. So the guidance was given last quarter, and this is on the AI. I mean, I'm using Fiscal AI. You can click on AI summary and have the information right away. Guidance. So they are guiding for 2026. FICO expects the revenue to grow 18% per year. They expect the net income to grow at 22% per year, and they expect the earnings per share to grow at 26% per year. And this and this and this. 20, 26, 24, 28. Anyway, they expect the earnings per share to grow at 25% per year. From history, I have learned that they are always doing better than what they are guiding for. So I think the business will grow at 30% per year this year, maybe 35% per year. And it seems like Wall Street is thinking the same thing. As we saw previously for estimates on Wall Street, I click on here, Fiscal AI, click on estimates, percentage change. Wall Street expects the earnings per share to grow at 39% per year. So the estimates, the expectations from Wall Street are extremely high. I mean, use Fiscal AI. You can use this website to have a wonderful platform that will do everything for you. The estimates, this is a pretty helpful tool. So everyone is bullish on FICO, which is the reason why it is trading at a premium. And now, given these high estimates, these high price to free cash flow estimates, you have a big discrepancy between the price to free cash flow of 46 and the forward price to free cash flow for 2026 at 30. The last time we had a forward price to free cash flow of 30 was back in the days in August 2023 and then February 2023. We are almost at the same valuation we were 3 years ago. And actually, I can start to be a buyer of FICO when it drops below a forward price to free cash flow of 30, which means almost now. If FICO drops a tiny bit, I will get very interested in buying FICO. And I will not buy a full position right now. I know it's still expensive. I know it's still high, but I have a lot of conviction for this business in the future, especially given the philosophy of my portfolio. When I did a big change in 2025 and came back to my roots of only being invested in asset-light, growing, efficient companies that are doing massive buybacks. FICO is asset-light. FICO is no monopoly. FICO is efficient. FICO is doing massive buybacks. And FICO is always doing better than their guidance. And FICO is growing earnings at 25-30% per year. So, of course, FICO is a prime candidate for my portfolio. But the valuation was always very high. You had a price to free cash flow of 70, 50, 40, and now 30. Actually, if we drop to a price to free cash flow, a forward price to free cash flow of 25, I will make it a huge position in my portfolio. So now we are starting to talk. Now we start to talk. I have been following this company since 2021. I know this business quite well. It's been 5 years of research now. So yeah, I think it's pretty inside my circle of competence. I was just waiting for a good entry price. And I think now 2026 will be immense for this business. And not a lot of things needed to move the stock up a lot. Because as you probably know, the mortgage market in the US is changing a lot. You have a lot of debt that is needed. What if in the future the mortgage market is going up massively? What if people are refinancing their lives? What if for some reason the new Fed chairman is lowering rates? I'm not doing a macro bet, I'm just talking in terms of probabilities. There is a probability for 2026, 2027 that the Fed lowers interest rates, that credit becomes more affordable. I'm not saying it will happen, I'm saying this is a scenario that can happen. If this is the case, for some reason, housing bubble, etc., you will have a lot more people that will need mortgage. And if this is the case, the mortgage market will get some more rhythm, and you will need many more FICO scores in the global US economy. So you have a few levers where FICO will benefit. One, FICO will continue to increase their prices like pigs. Every year they will just raise prices and make more money. Two, they will change their business model a little bit to go directly to their consumers. So they are doing some partnerships. Maybe it will accelerate growth. Three, maybe people will need more mortgages. And if the interest rates are going down, people will jump to refinance their credit ecosystem. So maybe you will have a lot more demand for the system. Three levers that can play at the same time for 2026. 2026, 2027. If this is the case, FICO has the potential to grow free cash flow at 25% per year for the next 5 years. If this is the case and you think the price to free cash flow will remain at 30 and they expect a buyback program of 3%, then if these are your estimates, the stock right now is 40% undervalued. And if you buy right now, given these bullish estimates, you can expect a CAGR of 17% per year. So I know this scenario is bullish, but it can happen. So the bullish scenario gives you a performance, a return of 17% per year. It's okay, it's pretty good, but I don't know the odds of this scenario coming. This is why I'm not buying a full position right now. I would love for the stock price to drop so that I can nimble and create a small position, and the stock price continues to drop to a forward PE ratio of 25, and then I make it a core position. I would love to sell some of my stocks in my portfolio and have FICO at a 10% allocation, like a core holdings. So far, the valuation is at a high point of my range. But if you had like a real threshold, the real threshold for me to buy would be below 30. So if the stock price drops, it will go to 29, 28, 27. I will maybe open a first position, first tranche. I buy it like a 3% position. And then if the stock continues to drop, forward price cash flow for 26, 25, second tranche, I can buy a second time. And if for some reason the stock price drops again, forward price cash flow of 24, 23, and now I'll make it a core position. So the average valuation for my buy price should be around 25. This is my plan for 2026 when it comes to FICO. I think we are in front of a beautiful business that has the potential to grow immensely, to improve their margins, and to continue their buyback program in the future. So you know it. You know my strategy when it comes to FICO. I'm a buyer. If it drops a little bit, you don't need a lot of things to happen right now. It is fair value for me at the moment. I just want to wait a little bit of a drop and then I will buy. So yeah, pretty compelling investment opportunity at the moment, given all the upside potential. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.